We are always looking at the information in the news to track the progress of any event, but we must also be looking into the statistics which will not be covered as well. Real figures. You will never get enough information by looking at the facts as they are. You must always be connecting the dots. You came here for the truth, so let me unveil that for you. Today we are going to look at the trade issues which are going on. We're talking about China, the US, I want to talk about Russia, Japan, and so much more. Let's get into it. I'm going to make this video quick. I say that every time and it never happens. How a $139 billion fund is trading the trade situation that's going on today. Well, this Australian investment manager is using the 30-year treasuries in order to be able to beat this. Well, I don't think that's necessarily going to be the best choice, but that's what they are doing, and I wanted to bring that to you because people are looking for options and are looking to make predictions based on what's going to happen. And they're suggesting here it gives us a bit of protection. Now, they also own other things, I'm sure. This is not their only investment. So they said that 6 weeks ago, we started increasing our duration in the 30-year part of the curve. And they've, like any other investment company, they are buying all sorts of different bonds. They've got their other portfolio of stocks and so on. So this right here shows me that there are companies now adjusting their portfolios based on the events that are taking place. So let's talk about that more. Now I want to show you what has happened with China, despite what we've been hearing in the news that yes, there's been a little ups and downs, but hey, everything is doing well. Well, you have to look at the GDP year-over-year growth in China has been declining. This is a level that we're not supposed to be seeing, but yet we are. What about their industrial production? Year over year, down as well. Look at their retail sales, year over year, down as well. And this is all, by the way, this dip downward in all of these situations is the financial crisis, okay? So in all cases here, we saw the same thing occurring where the market had come down, okay, then it recovered, but it's been sliding ever since. And the PBOC, the People's Bank of China, the Central Bank of China, is actually engaging in a lot of different, they have the monetary and fiscal stimulus, so they have their central bank, the government is doing this as well, they have their subsidiaries going in and buying up shares. They have all sorts of scams and schemes that they've been running, no different than their counterparts in the West. So this is an important thing to understand, that China is in some difficulties today. Yes, they're growing faster than the US. Yes, they're growing faster than other Western nations, some of them. And you will see that, hey, this is not necessarily as bad as it is in Greece. It's not as bad as it is in Italy, maybe. But this country here is not going to go along without any problems along the way. And what's happening now between China and the US is only going to exacerbate the issues. Now, there have been some reasons for all of this. I want to cover some more detail. This right here is from an interview, and basically, I just found some points from it. The person being interviewed made some really good points, so I wanted to show that to you. It is a translated article, so it's probably not very accurate, but we'll get some good details from it. In the past 10 years, we have been safeguarding the interests of the industry. Today, I personally think that any economy does not exist in isolation. That is, of course, what I always talk about with globalization. And any industry is not isolated. The real estate industry, especially our Chamber of Commerce, should look at China as a whole from a macroeconomic perspective, economic structure and composition. The Chinese people have the lowest debt ratio in the world a decade ago. Okay, and that's the mentality that people have. If they're listening to the mainstream, they're still quoting things that was from 10, 20, 30 years ago. Well, this gentleman here said, what is the current situation? The Chinese people are one of the highest personal debt groups in the world because the money is all in the house and people put everything they can into real estate, and that's good in a sense that they are investing in real assets, but you don't want to have all your eggs in one basket, as they say. You want to be able to be diversified, particularly when you're using leverage. If you're using leverage, you have to be extra careful. But people buy up equities on leverage, they're using margin, and they're making a big mistake. I think China now has these two time issues. One is a real estate bubble, and there is also local debt. I think that China needs to consider how to prevent the real estate bubble from bursting, and they're not doing that. They're actually loosening their lending standards. This should be one of our strategic priorities. If we are still pushing ourselves up, we cannot cure the bubble if it's not limited. Once there is a bad possibility, it will burst quickly. That's exactly what I'm talking about. So I'm glad that someone in China is saying the same thing. If we do not fix the problems today, it's not going to be an easy landing. It's going to make a big mess. It's going to make a big mess, and there's no doubt about that. So I'm going to move on from this. China's M2 year over year, you can see that has been declining now since the financial crisis, that peak there. Even if you take it from back in the 90s, it's still the same case. You can see that we have been up and down, yes, for sure, but that growth that they were experiencing a little while ago, not the case today. This here is important because of what's happening with the trade issues. I want to focus on what's going on in China. I want to see how they're reacting. An independent Chinese refiner has suspended crude oil purchases from the United States and has now turned to Iran as one of its sources of crude. So here we have it, just a small example. I'm sure it's not a big deal, but if they all start doing this, this could be a huge issue. The source said that Beijing is planning to slap tariffs on U.S. crude oil imports and replace them with West African and Middle Eastern crude, including Iran. Now, that's something that I think is really dramatic, that it could have an effect. Not today, not because of this one refiner, but in the longer term. They don't want to be dealing with the US, but hey, they're good business. If there's somebody there going to buy their products, they're going to sell it to them. If there's a way that they can get cheap crude oil from a different place because they want to be diversifying, they don't always want to be pulling it from, let's say, Saudi Arabia. They want to have diversification. So what do? They go to the US. Okay, sure, we'll do business. Let's be good partners. And then all of a sudden you got these sanctions, you got tariffs going on. They're saying, you know what? Why not get it from somebody who's willing to do business with me? Who's not willing to put up barriers in between you and I. Sure, I'll do business elsewhere. And that's what's going to happen here. We could see some new alliances forming and stronger alliances building up between nations that are already doing business. You could see this right here. Russia and Iran had a meeting together. You could see Putin on the right-hand side there. You've got some of the higher level people from Iran on the left. And this is part of that. Moscow and Tehran are expanding economic cooperation, with Russia planning a multi-billion-dollar investment in Iran's energy sector. The move comes as major Western firms are pulling out of Iran amid the threat of U.S. sanctions. Russia is ready to invest $50 billion in Iran's oil and gas sectors. That's going to happen right now, and we will see all this summit that's taking place, that we know that everything with the US, with Russia, that's going to be perhaps discussing some of this. And I'm really anxious to see what comes out of it, because there will be a big deal after it all. I know that we're going to get some information that's going to make a difference. Whether or not that's going to be good, we'll see. But it's important to know what comes out of those meetings. All right. So it's talking more about the all the deal. If you want to read about the deal, you can do that yourself. Then to switch over to Japan. I covered this before, but I'd like to just bring it up quickly because I have another chart to show you, and that is the pension fund in Japan. This is it's a massive institution, to look at it that way. All of them are. You have the same thing in Norway and so on. Although Japanese equities have topped the 25% goal so they hit that mark, they're only allowed this much, the ratio can exceed the target by a few percentage points. Investments will not stop. So they're simply saying that they're going to allow it to continue. Okay, but the GPIF, okay, the Government Pension Investment Fund, is now less likely to be a force that elevates the market as it did in the past. So understand that what we had seen Japan doing before can't be done anymore. So they're going to have to go out and straight up buy up shares yet again, and they already are. But I think that we can see either some money leaving, and this is the drying up of liquidity, or we're going to see more money printing going directly in to buy up the shares. And here is the asset allocation of that fund if you're interested. I just wanted to bring that to you because I thought it was interesting the way that these work. You know, these big, huge funds that are being set up in places like Norway, Japan, and other areas where you have these massive, I mean, in the case of Norway, I think it exceeded $1 trillion if I remember correctly. Anyway, don't quote me on that, but it was a huge number. I did a video about that. These are massive, and they make a difference when they start to say, oh, we're going to start doing this or that, because the investment institutions are watching what they do and they're reacting accordingly. So that's all for this video. If you found it informative, please give me a thumbs up. Remember that your thumbs up is the easiest way to support me. It just takes a second. Just click that button and it would really help me out very much. If you haven't already, I don't know why, but you want to join the 117,000 plus subscribers that are here on the channel. It's growing every day, and I want to say hello to all the new people out there. And if you want the financial education that was not taught to you in schools, these two books have it all. All you need to do is check them out in the link in the description below. I cover everything from the foundation, the history, I get into the asset classes, how to make money, how to profit, how to do everything you need to in such an easy, simple way. Okay, so you can check those out in the links. If you prefer the audiobook version, you can get that at themoneygps.com.